Hey guys, today I'll be going over Smile Direct Club. I'll be going over the 10K for 2019 and the most recent 10Q, which is for Q1 2020. A link for the 10K and other documents is going to be in the description below. Before I get started, please like and subscribe to my channel. I would greatly appreciate it. So, Smile Direct Club was founded in 2014 by Jordan Katzman and Alex Fenkel. And basically, their business model in a nutshell is that they manufacture clear aligners to help people straighten their teeth at an affordable price. Now, the way it works is two options. One is that the patient or customer can go to what's called a smile shop. And as of today, as of Q1 2020, there's about more than 400, mostly in America, but they've also have expanded in other countries. So you go to a smile shop, you could take an impression, which is basically a mold or a model of your teeth, and that gets sent to a dentist who looks at that and approves your case and offers you the treatment plan. Or you can do the same thing and you can order the impression kit online. I think it's about $45 or $50. They send you the impression kit. You do the same thing. But you do it yourself, and then you send it over. And so dentist looks it over, gives you the case, you approve it, and if you do approve it, usual treatment length, according to them, is about 6 months, and hopefully the goal is that you get straightened teeth. All right, you can look more into detail in the member journey on their 10K. They go over it in more detail. Now, aside from their smile shops, they also have a few master lease agreements with certain big retailers like CVS, Walmart, Walgreens, where they offer their services and products. And this is mostly in places where, in areas that they don't have a smile shop presence in, they use these retailers to infiltrate that area. So let's talk about costs. They sell the clear aligners. The full treatment is $18.95 full retail price. The average selling price is about $17.70 in the most recent quarter, and this is because of concessions and discounts they offer for patients. They also offer a financing option. It's an in-house financing option, what they call Smile Pay. It's at a 17% APR. You give $250 down, and it's about $85 a month. They report a 10% delinquency rate, and this is important. 65% of customers choose to go this route. Let's get into some business metrics. All right, so this is from their goals for 2020 in their presentation to investors in February. Now, of course, this was before COVID-19 hit, so the timeline has probably changed a bit, but their long-term margin goal is 85%. Now, currently, as of Q1 2020, it's about 70%. Their long-term sales and marketing goal is 40 to 45%, and again, as of Q1 2020, it's about 72%. And the amount that they spend on general and administrative issues and salaries is 15%, but currently they're sitting at 37%. So currently they are losing money, but again, long term their goal is 25% to 30% adjusted earnings before interest, taxes, depreciation, and appreciation. So these are some important numbers to look at for future quarterly reports and see what kind of trend they're going in. Some more business metrics. So again, as I mentioned, they're smile shops. They're mostly majority of them are in America. Now they've expanded to Puerto Rico, Hong Kong, Ireland, Canada, Australia, UK, New Zealand. This is one of their approaches to how they want to grow. They want to expand these smile shops and thereby expanding their presence globally. So far, they've shipped over about 1 million aligners, and you can see the aligners, the numbers they shipped throughout the past couple of years. So you see a nice increase. quarter by quarter, and that's basically how they generate their revenue. And you can see that um, as they've sold more products, their revenues have been going up, um, and that's quarterly increase, and below is the yearly. All right, so this is important. They're the way they get their aligners. This is how they measure um, whether it's a new patient, how they're coming in. Is it through social media? Is they're searching for them, or are they hearing it from a friend? So they're reporting that it's about 20%, and the percentage referrals, the 20% number has stayed constant, which is important. So that tells you that people are going out and buying the product, and not just that, but they're having good results so that they can tell their friends about it. So that's a pretty important metric. And right below is currently they're at 418 smile shops. Let's go over to the balance sheet. Just a few numbers I'm going to point out. First is the cash on hand, which is 225 million. Decrease in cash from 3 months ago was driven by the negative earnings from this quarter, which you'll see in the income statement that I'll get to. Second numbers that I'll be highlighting are the current liabilities and current assets. And as you can see, that they have enough to cover their current liabilities if you're worried about how badly COVID is going to impact them. And they do have enough cash, um, and with the openings of economies, I think they'll be fine in this regard. Now going over to the income statement, just a number I want to highlight is the gross profit. So they had a good gross profit last quarter, 136 million. However, their marketing spend was off the charts last quarter, which they said on their most recent earnings call that they're going to scale back. But it was 142 million their marketing spend, which overall, if you add that up, um, it they came out to a loss of 107 million for the quarter. Okay, so let's talk about how the company can grow from here. So different options. One is they can increase demand and conversion rate from patients getting clear aligners, increase their brand recognition, and increase insurance company reimbursements, and also adding insurance companies. They recently add a few insurance companies that accept their product. They basically reimburse Smile Direct Club if the patient wants to come. They use their orthodontic portion of their insurance to reimburse them. They can also expand international expansion. Again, they just recently started going outside of America with their smile shops, and I think they're going to continue this. Introducing new products. Now, this is a smaller kind of area. They are selling whitening products, electric toothbrushes, but this amounts to a very small percentage of their total revenue. Their total revenue is really their clear aligners. Mergers and acquisition. We'll get to a few other companies that have started this as well. Smile Direct Club is the biggest in that it's the biggest direct-to-consumer clear aligner company. Now, the biggest company overall that markets itself to dentists, of course, is Invisalign. Another growth opportunity is expanding their master lease agreements, again with CVS, Walgreens, and other retailers, and then again adding more insurance companies to their plans. Now, this is from their presentation that they gave investors in their most recent 10K. And again, they anticipated growth rate of about 10 to 20% in North America. They want to expand in international markets, and they have a higher growth rate there. And overall growth rate, they are expecting a 20-30% growth. Okay, let's talk about some economic moat, which is very, very important, and competitors. They do say they have some intellectual property. This is not, that you can just read up on it, but this is nothing that's gonna um, increase their value significantly. So their competitors, there's three clear aligner competitors that also are direct to consumer. You might have heard of them. Um, I've seen them on Facebook a few times. So one is called SnapCorrect, one is called Smile Love, and one is called Candid Company. Um, Now altogether they have a very much smaller market share than Smile Direct Club. So they had the advantage of the first mover advantage, and they have taken a big market share. And then there's also traditional clear aligners from the orthodontist. Again, this was the what I mentioned earlier, Invisalign. Invisalign is a publicly traded company under the ticker ALGN. The market cap as of May 2020 was 16 billion, and their 12-month trailing revenue was 2.4 billion. As comparison, Smile Direct Club is about 750 million. So, about 4 times bigger in terms of revenue. Let's talk about the quality of the management. Okay, so quality of they do have a dual class structure, which does have its drawbacks. Um, there are other ones that have dual class structures. The big companies you might be aware of, Snapchat, Dropbox, Google, and that basically one of the major drawbacks is voting. The common shareholders don't hold as much power in voting, um, and so with Smile Direct Club, you can see the top people: David Katzman, Jordan Katzman, Stephen Katzman, which I think is the uncle, I believe, um, and then the other founder, Alexander Fenkel. Together, they have almost 90% voting power. So, and the voting power determines on what changes their company is going to make. So, you can view that as a risk, or as a negative, I mean. So the CEO is a hired hand. He's not a founder operator. His son um, founded the company. Now the dad is running the show. Granted, he does have experience. He did run, and he's still running Camelot Venture Group. Um, but personally, I'd much rather have someone who's there from the beginning. And I did find these couple of snippets on the 10K. So apparently, the Katzman issued some promissory notes to the company, and the company is paying back Katzman with a 10% interest rate. I mean, is that necessary? 10% interest rate? I don't know. So I just hope it's not a CEO that uses the company as a sort of personal piggy bank. And this is just some more information on the dual class structure, some risks involved and some negatives. Again, a link is in the description below. Some other operational risks and considerations. Now, this is in the 10K if you're interested. They go over all of them. And for those that are unfamiliar, they list the risks on the 10K. They should list the risks in order of importance. So if you want to take a look at that, that's going to help you understand, potential downfalls for the company. So just some straightforward risks are that, can the company sustain the growth that they have been so far? A big one for this specific company is advertisement and lawsuits from national and state dental boards, because this is healthcare field, so they are regulated by state dental boards, and they have to abide by the rules. Another consideration is that the CEO is the founder's dad, and the CEO is the founder's uncle. So they're kind of kept it in the family, which could be a bad thing. or not, but yet to be seen. Again, the dual class structure, which I alluded to earlier, um, there's a small credit risk, which there can, over time, especially with with COVID and the economy, now there could be a higher delinquency rate. Although they did report no changes in their most recent call. Again, increased competition, lower revenues. This not too worried about, again, because they have first mover advantage. They have a big market share. Another risk, of course, is COVID dragging on, maybe a second wave coming, limiting growth from smile shops. You can read all these and all these risks and more risks on their 10K. Just to expand a little bit more on the lawsuits from state dental boards. So the company is regulated by state dental boards, and they have informed shareholders that two state dental boards have established new rules that would limit their business. So far, these two states are Georgia and Alabama. And basically, what they have stated is that they require a dentist to be in place when that impression of the mouth is taken, the mold of the mouth. So therefore, you need a dentist there, and obviously, this is going to decrease their efficiency, increase their costs, because currently they're not paying anybody, any dentist, to be there on site. But these two dental boards are saying no, you have to. So and they're countersuing. They're trying to have the lawsuits dismissed, but these are potential risks if it continues to other states. All right, so let's discuss a fair value. I think an appropriate metric for this company at this stage is to kind of put it up against a competitor. And in the clear aligner industry, there's only one other competitor, and that's Align Technologies. So let's compare both of their financials and see how Smile Direct Club stands. So comparing their revenues, again, Align Technology is almost 4x more in revenue. Now, Align Technologies has been profitable for a while, whereas Smile Direct Club is still in its growth stage and it's still not profitable and losing money. So their most recent net income showed a loss of 115 million. But as long as the revenues show a increase, then they can create efficiencies in their other metrics and produce profitability. Now you can see what the street values Align Technology as when comparing their revenue. And so I think Smile Direct Club has a chance to get there over time. As they expand with their smile shops and expand with their presence, because when you compare Align Technology, when you go to a dentist and get clear aligners, I think they charge about maybe 5,000 to 7,000, and so there is value there. Patients can save upwards of $3,000 per treatment to straighten their teeth. So I think there's a lot of value, and it's shown in their increase in revenue, an increase in their growth. So I think if it continues, they have a chance in matching Align Technology. Now there again, there's some kind of negatives that I didn't like, which is kind of the family members and the executive team, and I don't know how that's going to work out, but from a business standpoint, I think they have shown some growth, and it'll be interesting to see how they go on from here. Okay, well, that's it. Thanks for watching. Please subscribe to the channel and like this video so I can produce some more. If there's a company that you want me to analyze, write it in the comments below. Thank you.